Good afternoon, everyone. Thank you very much for being here, and thank you, Xuan Wang, for Scholarship Fund, for providing me this opportunity to briefly talk about my research. Today, I'm going to talk about modern macroeconomic research, and mainly I'm going to focus on two things: default and maturity mismatch. I'm going to walk you through the introduction of the background knowledge and also the methodology that is predominantly used in modern macroeconomic research. And then I'm going to touch upon the model sketch for analyzing default and maturity mismatch. And after that, from the mass derivation, what kind of equilibrium analysis we can obtain. And when we bring the mass to computer program, what kind of quantitative analysis or experiments we can do regarding a specific financial regulation, which is called net stable funding ratio. And then I'm going to touch upon the conclusion and model extension to country-specific characteristics, such as those of China. Well, please allow me to start my presentation by quoting the famous economist Thomas Stochastic, who is a Nobel Prize laureate in economics. He says, "It is just wrong to say that this financial crisis caught modern macroeconomists by surprise. That statement does a disservice to an important body of research to which responsible economists ought to be directing public attention." So basically what he's trying to say is that the 2007 and 2009 financial crisis is not something new. And actually, ever since the Great Depression, there has been substantial growth in literature on the risky nature of the capital market. And we categorize this body of literature into three groups: crisis management, risk identification, and pre-crisis risk management. In terms of crisis management, one of the conventional wisdom is that when crisis happens, central banks have to timely step in, providing liquidity to the market, lowering interest rate, boosting demand. If that does not happen, and then there is that deflation mechanism set in place, exacerbating the crisis. If you want to know more about the deflation mechanism of the Great Depression, a very good starting point is the paper written by Irving Fisher in the 1940s. But this group of literature has a problem, because it only tells us how to deal with the bad situation, but it doesn't tell us how to prevent bad situation from happening. Parallel to this literature becomes the second group of literature, which talks about how to identify the risks, financial frictions, and moral hazards in the financial system. And it basically uses game theory and principal agent framework to analyze this problem. But the thing with this group of literature is that it leaves little room for discussion in terms of specific policy implementations. Once we identify the risks, how do we deal with the risks in the financial market? Since the recent financial crisis, the third group of literature becomes all the more popular. It's about pre-crisis risk management. Say if there's a regulation set in place to regulate the financial system, we want to analyze what is the impact of this financial regulation on macroeconomic variables. To make this more concrete, let's think of a metaphor. Imagine you yourself is driving a car in an expressway, right? And then you understand there is friction in the air, that's the air resistance. If you understand how air resistance works, then you can design your car in a streamlined fashion so that you can drive your car smoothly. The same for macroeconomic research. If you can understand the financial frictions and moral hazards and the risks in the financial market, and then you can design relevant policies to make things work in your fashion. Specifically speaking, we're going to analyze two major frictions that were manifested in the recent financial crisis: default and maturity mismatch, and a specific macroprudential policy rule, which is called net stable funding ratio, to deal with such frictions. What do I mean by those? Simply speaking, imagine that you lend money to a bank. A bank comes to you to borrow money, and the next period the bank says, maybe I'm not going to pay you back. If that situation happens, then that's a default. And it's not unusual when this kind of scenario happens. And the default is a choice of the bank. And what do I mean by that? If a bank chooses to default, and obviously its profits will go up because the bank doesn't need to pay you back the money. On the other hand, the bank suffers from reputation damage, right? Or in the next period, if the bank wants to borrow from you again, you may find it a bit difficult. So the bank makes a choice whether to default or not. If it defaults, how much to default. And the second friction in the financial market is maturity mismatch. For those of you who have accounting knowledge, this may be a familiar term. Let's see a simplified version of a bank's balance sheet. Imagine a bank comes to you to borrow money, and you put your saving in a bank, and the deposit is just 1 year. But what if the bank uses the 1 year deposit to finance a 4-year corporate loan or a mortgage loan? And that is a problem. Why? Because the next period you go to a bank, you ask for the money, and the bank says, this is still in the mortgage loans, which is 4 years, or in the corporate loans. So as you can see, the deposit is 1 year, but the mortgage loans or corporate loans are like 4 years, or even 8 years. So there's a maturity mismatch. When that happens on a systemic level, the financial system becomes very unstable. And when there's external negative shock, financial crisis happens. To deal with the situation, policymakers have formalized this rule, net stable funding ratio, which is designed to reduce maturity mismatch in the banking system. But whenever policymakers are thinking about some novel ways to regulate the banking system, a very natural question we're going to ask is, if this really is implemented, what is going to happen to the macroeconomic system? Obviously, a very direct impact is a reduction in maturity mismatch, because this regulation is designed to reduce maturity mismatch. But let's take the question one step further. What would happen to other macroeconomic variables? What's going to happen to investment, to inflation, output, welfare of various agents, and default? And if we're going to implement this regulation, how we should implement it optimally. To answer this question, a very interesting or useful tool we use is called Dynamic Stochastic General Equilibrium Model. We use the model to answer specific questions in terms of what kind of impact of financial regulation. What do I mean by general equilibrium? It's very simple. Imagine everyone in here is making some sort of transactions in the economy. We're constantly making choices, how many goods to consume, and how many houses to buy, and how much saving you want to put in a bank, and how much labor to supply, and so on and so forth. And the firms make choices too, and the banks and central bank fiscal authority have their own objectives. And the choices are constantly interacting with each other. Like all the economic decisions are interacting with each other, forming the macroeconomic system. And it's a dynamic process because we're constantly making choices to make us feel better. And also there's a stochastic element in it, which means there's some random shock hitting the economy, causing the macroeconomic variables to fluctuate over time. Metaphorically speaking, you can think of it as an ocean. Feifei talked about ocean just now. And if we know the ocean, how the ocean is formed, right? Each water drop is interconnected with other water drops. Like the economic decisions in the macroeconomic system are interacting with each other. So you've got this system. But what if there's a gentle breeze blowing over the surface of the ocean? You're going to see the fluctuations of sea waves. And that is how the policy can influence macroeconomic variables. Simply put, we're going to model the whole economy. We've got firms in the economy and households like you and me, and also retail bank, wholesale bank, fiscal authority for implementing fiscal policies, and also the central bank responsible for monetary policy and financial regulation. I'm not going to reach into the technicalities of the model, but simply speaking, the basic idea is for everybody in the macroeconomic system, we have an objective. For example, the household chooses how much to consume, and how much labor to supply, and how much capital to supply, and also how much to put aside saving in the bank. The household optimizes its own objective function with respect to the set of resource constraints, because we have limited resources. So that's a problem for the household. And likely for the firm thinks about how to maximize its profits over time. So this is a dynamic process. And also it has to think about what kind of reputation damage it will incur if it start defaulting on its borrowings. So there's a reputation or regulation damage if it start doing it. So the firms are making choices all the time with respect to this set of constraints, and also it's a dynamic process. The same for the wholesale bank, and the same for the retail bank. And then when we integrate all of their economic decisions together, we get a macroeconomic system. And the central bank obviously is responsible for implementing monetary policy and financial regulation, and the fiscal authority has a budget constraint. So this is the model setup. After we're setting up the model, we do the mass derivation. We arrive at the optimality conditions for each agent in the economy, and we can actually arrive at some interesting propositions. There are altogether 5 propositions, but I'm going to only focus on one, which is the key proposition on the interplay between default and maturity mismatch. And we can actually mathematically prove that a decrease in maturity mismatch inclines the firms and the retail bank to decrease the default rate. But what is the intuition, what is the idea behind it, apart from the mathematics? A decrease in maturity mismatch of the corporate loans means a decrease in the maturity of the corporate loans. And if that happens, the firms have to pay back more of its loans at the current period. When that happens, the magnitude of the punishment for its default gets bigger, and the firms don't want that. That's why the firms have the incentive to decrease its default rate. And the idea is as simple as that. And of course, this is just a partial equilibrium perspective. We want to bring the mass into computer program to simulate from a general equilibrium perspective to confirm our equilibrium analysis, and we arrive at this graph, impulse response functions. Remember the ocean I talked about at the very beginning of the presentation? There's a very large ocean, right? And it's very peaceful. When you implement certain kind of policies from the outside, the policy or the gentle breeze is going to induce the surface of the ocean to fluctuate over time. And this is how those macroeconomic variables can respond to this financial regulation, namely net stable funding ratio. And the key graph we're going to see is the relationship between maturity mismatch, retail bank default, and firms default. And as you can see, a decrease in maturity mismatch corresponds to the decrease in the retail bank's default and firm's default, which is consistent with our proposition. After we do this computer program or experiments, the next question we're going to ask is, how do you know your policy is good? How do you make sure your policy is a gentle breeze rather than a strong gust of wind, disrupting the whole system? So we do optimality experiments again, considering the regulations. And the conclusion we reach is that monetary policy and macroprudential net stable funding ratio regulation should bear counter-cyclical features. What do I mean by that? If the economy is overheated, you want to make the policies more stringent. If the economy is going down or going slow, you want to make the policy more lenient. And that is also consistent with the conventional wisdom, which is the main conclusion of this research. And now I'm going to touch upon the model extension feature in China. Because the model is highly structured, we know the behavior of economic agents in this system. Then we can actually modify the assumptions underlying the model to adapt it to specific situations. For example, in China's case, the household may have limited portfolio choices. We have a very strong incentive to put all our money into the bank because we have limited investment channels. Or sometimes we put our money into the mortgage markets. But the thing is, faced with this incomplete financial market and borrowing constraints, theoretically speaking, we're going to have a very strong precautionary saving motive. And when that happens, that would lead to income inequality. And this is one aspect we can use our model to analyze. And also in China, there are heterogeneous firms. We can categorize the firms into state-owned enterprises and small-medium enterprises. And maybe they have the same objective, which is profit maximization, but they have different resource constraints for sure. If that happens, maybe we will reach into different conclusions. And also in China, the interest rate of the market is not determined by the market. So there's price control on the interest rate. And when there is such constraint on the price control, what's going to happen to asset prices? That's something we can examine too by modifying the model to the China's case. And also, what's unique about China is that the central bank conducts open market operations through central bank note issuance, rather than, well, unlike the case in advanced economies like here in the UK or in the US, the central banks buy and sell government bonds in order to conduct open market operations. One of the caveats remains for this model. Because it's a model for short-term transmission mechanism, it's not appropriate to use it to analyze the long-term trend. To model long-term economics, overlapping generation model or principal agent framework will be more useful. To recap, what have we talked about? We've talked about how the ocean is formed. We've talked about how the macroeconomic system is formed by various economic decisions from you and me. We've talked about how the policy is going to induce the ocean, the surface of the ocean to fluctuate over time. And we've also talked about how to implement specific policies so that you don't want to create a tsunami. And thank you very much. Now I think it's time for questions and answers.
Any questions?
Hello. I was very interested in the structure of your presentation, but it made no real relationship to the previous presentation about the impact of carbon and climate change. And so while it was very interesting to see the mechanics of the present economic system, really speaking, this is a result of the impact of a carbon revolution of the last 200 years. We're now facing the challenge of creating a low carbon revolution in order that we can have life on Earth secured for your generation and most of you here that could hopefully expect to live for 100 years. The present scenario of the UN Climate Committee on climate change has indicated we're leading into a massive crisis unless we reverse the amount of carbon in the atmosphere and in the oceans, which is now at a premium point. It cannot absorb any more carbon. So there appears to be the classic economics on the one hand, defying the evidence of the need for the low carbon economics for the future.
Well, thank you very much for your question. To answer your question, there are 2 points. Point 1, as I've just talked about, this model from my research is for the short-term transmission mechanism, focusing on monetary policy and financial regulation of the central bank. So in order to analyze the long-term impact of carbon trade or carbon economics, a more appropriate model would be overlapping generation model or principal agent framework. And in that regard, that brings to the second point, that would call for some collaboration between economists and also people doing geographic research or climate change to see how we should model the specific behaviors in the economy so that we can see the long-term impact of carbon trade. For now, this research, what I'm doing is from an MPHil thesis, and it only focuses on the frictions in the financial markets. But it would be feasible if we look at the long term, when we analyze or understand the frictions in the carbon trade or carbon economics, it would be feasible to use structural model and by applying calibration from real data to simulate the impacts of carbon trade. Thank you very much.
So, one more question.
Thanks for the presentation, Alex. It was great. I'm just wondering on this extension featuring China section, if there was one policy recommendation for reform you would choose in the context of China, given this model, what do you think it would be?
Well, to answer your question, let's look at the demand side and also the supply side of the economy. From the supply side, if you think about the production of the economy, there are basically 3 pillars. Research, which means technology, which translates to technology, labor force, and also capital. So for each of these 3 pillars for economic supply, we can implement specific policies. More specifically, in terms of research, the major policy move for the government is to place more emphasis on education. That doesn't mean the establishment of more universities, but it basically means more encouragement of free thinking, because that would translate to the improvement in technology. And the second element of the supply of the economy is capital. You want to enforce property rights to incentivize private sectors. When people's property rights are guarded by the law, people have the incentive to make profits or to improve their own lives. And also the labor force. As you know, the labor force in China is shrinking. But the key solution for that is not to, encourage people to bear more babies in the future, but to educate people so that more and more labor force will become highly skilled labor force in the future. And on the demand side, one of the major policy moves that China is taking is try to experiment in financial markets. Because in China, the financial market is highly incomplete in the sense that we don't have enough securities or financial securities to hedge the risks or uncertainties in the future. And when that happens, the predominant motive for us to save our money is to put our money into the bank, which has a very low interest rate and is not governed by the market. And when that happens, and when we're especially faced with different sets of borrowing constraints, we have very strong incentive to save more money rather than consume. And the government has this tendency to encourage more people to consume because we are sort of in the transitional stage from an export-led sector economy into a consumption-driven economy. And if financial market is well developed in a sense that this reform is successful, then on the supply side, people have more incentive to consume, and there is more incentive for innovation and for production, so on and so forth. And overall, what we also need is the enforcement of law. China's legal system is actually quite well-rounded, but one of the problems is that the law enforcement is not very strong. So when there's, say, corruption or there's moral hazard in this financial system, and there are no metrics set in place, there are very few metrics set in place to regulate or to ameliorate moral hazards in the system. So those would be the three things that we can do at this moment to tackle the difficulties facing China's economy. Thank you very much.